The balance sheet. The balance sheet is a snapshot in time of a company. The only two things that you will find on the balance sheet are the assets and the liabilities. The assets of the business, less the liabilities that the company owes to third parties, is known as the net assets. That is the assets net of or less the liabilities. The net assets of the business is accounted for as a liability, as it is an amount owed by the company back to the shareholders. But we don't refer to it as a liability, as the company does not have to repay this amount unless it ceases trading. The assets of the business can be divided between non-current, also known as fixed assets, and current assets. The liabilities that are owed to third parties can be divided between non-current, also known as long-term liabilities, and current liabilities. As previously mentioned, the net assets of the business are owed by the company back to the shareholders, and so are known as capital and reserves or shareholders' funds. In order to understand the difference between these five categories, let us look at a company's balance sheet. In this example, we will use Tesco, a major supermarket in the UK. Here is Tesco's balance sheet. The top half of the balance sheet shows the assets of the business. The lower part of this has a section called current assets. Current assets are things such as inventory, also known as stock, trade and other receivables, also known as debtors. These are people or companies who have bought things from Tesco but have not yet paid for them, and cash. Tesco is trying to sell its stock on its shelves and is trying to collect the money owed to it by its debtors. Thus, current assets can be defined as amounts that are owed to the company that is either trying to turn into cash within 12 months from the balance sheet date or already are cash. Tesco has current assets of approximately £13 billion. This is as opposed to non-current assets, which are things that the company needs to run the business. Things such as tables and chairs, buildings, plant and machinery. It could turn these into cash by selling them, but it doesn't want to, as it needs them to run the business. If it sold the building, it would have nowhere to sell its stock from. Total non-current assets for Tesco is 38 billion, meaning that Tesco has total assets of approximately £51 billion. So that is the assets of the business. The bottom half of the balance sheet shows the liabilities of the business. Under current liabilities, the largest amount is trade and other payables. If trade and other receivables relates to debtors, that is people who owe us money, then trade and other payables relates to creditors, people to whom we owe money. This represents the suppliers of Tesco who've supplied goods and services but have not yet been paid. There are also amounts relating to loans and borrowings. These are amounts that have been borrowed for a long time but are now due to be repaid. So current liabilities are amounts that the company owes and that it has to repay soon, within 12 months of the balance sheet date. The total current liabilities for Tesco is approximately £19 billion. Non-current liabilities are therefore amounts that the company owes and that they do not have to repay within 12 months of the balance sheet date. The biggest number here relates to borrowings, the amounts that the company has borrowed to fund its operations. Total non-current liabilities for Tesco are approximately £14 billion, giving Tesco total liabilities of about £33 billion. So, to summarise Tesco's balance sheet, Tesco has non-current assets, sometimes known as fixed assets, of £38 billion, current assets of £13 billion, current liabilities of £19 billion, and non-current, also known as long-term liabilities of £14 billion. 38 billion of non-current assets plus 13 billion of current assets gives 51 billion of total assets. 19 billion of current liabilities and 14 billion of non-current liabilities gives total liabilities of 33 billion. 51 billion of assets less 33 billion of liabilities gives net assets of 18 billion. The net assets of 18 billion is the same as the shareholders' funds. The shareholders' funds is also known as capital and reserves or total equity. This represents the total amount the company owes back to the shareholders should it choose to cease trading. It is not actually a liability, as it does not have to pay it back to the shareholders, but is accounted for as a liability. The total equity is essentially made up of two elements: the original or any subsequent investment by the shareholders in the business, this is known as share capital and share premium, and any retained earnings, this is the profit that the company has made ever since it started trading and has not yet given back to the shareholders. There are some other reserves in there too, but these are quite small and we will not worry about them here. We have now identified the 5 key elements of the balance sheet. Therefore, we can crack the balance sheet. We have already established that Tesco has non-current assets of 38 billion, current assets of 13 billion, current liabilities of 19 billion, and non-current liabilities of 14 billion. The net assets are also known as the shareholders' funds or total equity, which for Tesco is 18 billion. Now, businesses are primarily funded through two sources, debt and equity. Debt can be found in the non-current liabilities of the business. Remember, debt is a liability, so it will not appear in either of the assets section and is borrowed from third parties such as banks. Debt is also used for long-term funding of the business, so it would be inappropriate to use short-term funding such as current liabilities, for the same reason that you should not buy a house on a credit card. The other source of funding is from shareholders in the form of equity. This is a combination of the investment that the shareholders have made into the business, that is the share capital and the premium, and the total amount of profit that the business has made ever since it started trading and has not yet paid back to the shareholders. In effect, the total amount that has been reinvested back into the business on behalf of the shareholders. Now, debt plus equity makes the total capital employed in the business. At an overall level, the non-current liabilities, that is the debt, of Tesco is 14 billion and the equity is 18 billion. 14 plus 18 makes total capital employed of 32 billion. So Tesco has 32 billion pounds of capital employed, and the balance sheet shows us the source of this funding. But what did Tesco do with that funding? Some of it was used to invest in the business, buying tables, chairs, buildings, plant and machinery, known as investment capital, which is what the company needs to run the business. This is the non-current or fixed assets of the business. In the case of Tesco, a total of 38 billion. But the business also needs sufficient funds to operate on a day-to-day basis, and this is called the working capital. The working capital is a combination of cash and things that are going to become cash soon, that is, the current assets, and the amounts that it needs to pay soon, the current liabilities. The net current assets, that is, the current assets net of or less the current liabilities, is known as the working capital. In the case of Tesco, this is a negative figure of 6 billion. In effect, the net current liabilities, i.e. the current liabilities of 19 billion, exceed the current assets of 13 billion by 6 billion. Investment capital of 38 billion added to the negative working capital of 6 billion makes a total capital employed in Tesco of 32 billion. Thus, the balance sheet not only shows us where a company sourced its funding from, debt plus equity, making the total capital employed, but also shows us where the company deployed that capital, investment capital and working capital. So, if you are ever faced with a company's balance sheet, by breaking that balance sheet down into the 5 constituent elements, this will allow you to crack the balance sheet. And that is how to read a company's balance sheet.